It's always important for businesses to control costs. When managed well, it can lead to improved profitability and better returns for investments. But how do companies measure the costs that are incurred to finance its business operations and investments? Welcome back to the Industry Portal's Finance Explainer series, where learning finance is made simple. In this video, we're diving into a topic that sounds fancy, but is super important in finance: the weighted average cost of capital, or WACC for short. Don't worry, by the end of this video, you'll know exactly what WACC is, why it's used, and how businesses and even investors apply it to make decisions. So let's get started. Alright, so what exactly is WACC? Well, WACC is a measure of how much it costs a company to finance its operations and investments using a mix of debt and equity. Essentially, it's the average cost of all the money a company raises, whether that's borrowing, i.e. debt, or selling shares, i.e. equity. Now, why does this matter? Well, if a company wants to take on a new project, like launching a new product, building a factory, or expanding into a new market, it needs to make sure the project earns a return higher than its WACC. Otherwise, the company is losing money. So let's simplify this with an example. Imagine a company raises its funding from two sources. Firstly, from debt, so borrowing money from banks or bondholders. Secondly, from equity, so selling shares to investors. Now, the company has to pay interest on the debt and provide returns to its shareholders in the form of dividends or capital appreciation. Both of these are costs, and WACC helps us find the average cost of this total funding. So here's the formula for WACC. So let's break this down. E equals the value of equity, i.e. money raised from shares. D equals the value of debt, i.e. money borrowed through loans or bonds. V is the total value of equity plus debt, so E plus D. RE is the cost of equity, i.e. the return expected by shareholders, and RD is the cost of debt, i.e. the interest rate on debt. TC equals the corporate tax rate. So we essentially work out the proportion of equity multiplied by the cost of equity, and then the proportion of debt multiplied by the cost of debt, and then multiplied by 1 minus the corporate tax rate, because interest on debt is tax deductible. I know what you're thinking. That looks far too complicated. But trust me, it's not as bad as it seems, and most of the time you'll have tools like Excel to help you calculate it. So here's a simple example. Let's say a company raises £1 million in total, with 600,000 coming from equity and 400,000 coming from debt. The cost of equity, i.e. RE, is 8%. That's the return shareholders expect. The cost of debt, so RD, is 5%. That's the interest rate on the loan. The tax rate, TC, is 20%. Now let's plug those numbers into the formula. We would get 600,000 divided by 1 million multiplied by 8% plus 400,000 divided by 1 million multiplied by 5%. Then we multiply this by 1 minus 0.2. So the company's weighted average cost of capital is 6.4%. That means the company needs to earn a return higher than 6.4% on any new project to create value. If a project only earns 5%, it's not worth it. It's actually costing the company money. So why is WACC so important? Firstly, it helps in evaluating projects. Companies use WACC as a hurdle rate. If a project's return is higher than the WACC, it's a green light. If it's lower, it's a no-go. Secondly, it helps when valuing companies. Investors use WACC to discount future cash flows when valuing a company, like in a discounted cash flow analysis. Thirdly, balancing debt and equity. WACC helps companies decide how much debt versus equity to use. Debt is cheaper because of tax benefits, but too much debt can be risky. Now, here's a quick tip. WACC isn't just for big companies. You can think of it as your personal cost of capital too. For example, if you're financing a property with both a mortgage, i.e. debt, and your own savings, i.e. equity, you'd want to ensure the property earns a return higher than your total cost of funding. So let's recap. WACC is the average cost of funding a company, including both debt and equity. It's used as a hurdle rate for investments, so any project or investment must earn a return higher than the WACC. The formula balances the cost of equity, the cost of debt, and the tax benefits of borrowing. And that's it. Weighted average cost of capital explained simply. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon for more videos just like this one. If you're keen to learn more about finance, be sure to check out the industryportal.com, link in the description below. Thanks so much for stopping by, and as always, keep growing, keep learning, and I'll see you in the next video.